You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
Hello, East Tennessee. Welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI, and we're going to talk about the state of the economy today. But before we dive in, I just want to give my shout out and congratulations to Rick Barnes and the Tennessee men's basketball team for such a great win last night. What a great time to be a Tennessee fan. We've got the defending national championship of baseball that's currently ranked number 1. We got 2 teams in the Sweet 16, both the ladies and the men. The Lady Vols last night beat the perennially best softball team in the country, Oklahoma, the 2-time defending national champions. So it's just a great time. We got 2 national championships in swimming this week. So it's just a great time to be a Tennessee Vol fan. So congratulations to our Tennessee Vols. Let's talk about the state of the economy here in 2025. I know that many people are a little bit worried. The stock market ended on a down market yesterday, ended on a down note, and we are in a stock market correction. And what that means is the market is down, has clipped over a 10% decline. So I know people are nervous about tariffs and this and that. Where do we stand? So I think today we want to look back and find some important takeaways from 2024. We want to talk about important topics in 2025. We'll talk about asset allocation and some important takeaways there. And finally, financial planning for 2025 and beyond, including a look into tax rates and what that might mean moving forward. So let's start with 2024. And what are some important takeaways? And the biggest answer to me is, in the last 5 years, how diversified is the S&P 500. The S&P 500 is an index made up of 50 of the largest U.S. companies. It is a weighted average index, and this is a very fundamentally important thing to understand. When we look at the 500 companies, they don't each have an equal weight on the movement of that stock index. It's not 1/500th each company. It's a weighted index. The largest companies have the largest impact on the movement of that index, and the larger they are, the more impact they have. And I'm looking at a chart right now. When we look at the largest 10% of the total value of the S&P 500, so that'd be the 50 largest stocks, right? I'm looking, as of right now, they account for over 75% of the total value of stocks. And that is the highest it's been certainly in the last 50 years, 55, almost 60 years. It's never been that high. Now in 2000, it got up around, it got up over 70% just after 2000. But right now it's over 75%. And so the big takeaway there is to just know, we can't just look at just the S&P 500. And you've also got to be careful in your investment plan. If you're primarily in the S&P 500, are you as diversified as you think? Because those top 50 stocks are worth 75% of the market value of all stocks. So, and it's being driven largely by what we call the Magnificent Seven, those big mega cap tech stocks. That's Apple and Nvidia and Microsoft and Tesla. Facebook. So there's 7 of them. At any rate, they're driving the market right now. And so, there's a danger that if you look at the S&P 500 as a diversified stock index, the reality is you could end up being overexposed to a potential technology bubble. And I'm not saying that it's going to burst, not at all. And hey, the last 5 years, there's been a lot of success. I mean, it's been hard to do better than the S&P 500 the last 5 years. But the reality is that also raises risks. So just be careful that you're diversified the way that you need to be. We want to have exposure to the S&P 500 in an investment plan. We want to be invested in those 7 mega caps. We'd be foolish not to. But we also want to make sure that that's not driving our entire performance. And again, this is a great time to assess that, because the last 5 years you would have benefited greatly from that. But you know, one of the things that we do at Brogan Financial is we do X-rays on an investment portfolio. So we have people come into our office, and we kind of do an X-ray analysis of what are these. You know, you might have 10 or 15 different mutual funds and ETFs, but how much overlap? If we X-ray every one of those companies and put them on a grid to show what you're actually invested in terms of sectors, in terms of U.S., in terms of size of companies, international, everything. Or do you have a lot of overlap? It's very, very common for us to see people have 8 or 10 or 12 funds. They effectively might as well just have 2. Because these funds, you look at their top 15 stocks, they're all invested in the same stuff. So just be careful and make sure. So how diversified is the S&P 500? The reality is in the last 5 years, it's become less diversified. And so when you invest, you've got to be careful that you don't have too much exposure to the downside if things went roughly for those mega cap stocks. Now let's talk about important topics in 2025. And I'm going to lead off here with an update on Federal Reserve policy. So the Federal Reserve, they have a dual mandate. Stable prices, which in other words, control inflation. And a little inflation is healthy, by the way. We don't want no inflation, but controlling inflation. And then their second mandate is full employment. So if unemployment's around 3.4, 3.5%, that's considered right at full employment. And so they're trying to manage both of those things. Now, as we know, interest rates shot up to try to control inflation. And in June of 2022, inflation, the 12-month inflation was at 9.1% was when it hit its high. And it's been coming down steadily. Now, in September last year, it got all the way down to 2.4%. And I realize it doesn't feel like 2.4%. Because prices are still going up and they're compounding on top of 9.1. So it's not like they're coming down. So when we say inflation's under control, the gut jerk reaction is, no, it's not. Or excuse me, knee jerk reaction. But the Fed does want it. They eventually want to get it to 2%. Now, since September of last year, it has steadily increased and it is now at 3%. So it went from 2.4 to 2.3. So what does this mean for investors? We believe that the rate cycle will remain on hold for the foreseeable future as the Fed works towards that 2% inflation target. We have seen new headlines on the impact of tariffs to the inflation picture. At this point, it's probably too early to tell how this will impact the Federal Reserve interest rate policy. I know we are starting to see a little bit of a slowdown in the economy. The GDP growth has started to slow down a little bit. And the Fed is going to want to stimulate the economy. And so that means, decreasing rates. But I think it's going to be a while. I think the second half of 2025, we'll see maybe a couple of rate cuts. Now, we don't know for sure. But the Fed wants to control inflation as well. So they want full employment and economic growth, which lowering interest rate should feed economic growth, but they also want to be careful it's not too hot because of inflation. And so that's kind of where I see that. So I do see rates continuing on a trend downward over the next couple of years. But the Fed's probably going to be slower than many investors would like. Certainly slower than President Trump would like, because he wants the Fed to lower rates faster. But we do have to be very, very cautious about inflation. There's a lot of world events going on right now, and we're going to get into all that. The next segment, we're going to talk about tariffs, okay? But there's a lot of going on all over the world. Many people don't love what they're seeing. Some people like very much what they see. And, how do politics affect all this? Because, things are so turbulent in D.C. We're so polarized. How does all that really, truly affect the stock market? But the Fed has a balancing act. They've got a fine line. And the number one thing that I'm watching and a little bit concerned about is, I don't want us to see stagflation. Now, what is stagflation? Stagflation is a environment where we have renewed inflation, not at 3%, but higher, 5-6%. Got inflation, and but the economy is not really growing. See, normally when we have inflation, the economy is also growing, just due to the fact of increased goods and services costs. Plus, typically in an inflationary period, prices as a rule rise, including investment prices. But in stagflation, that's not what's happening. We see, inflation with no real economic growth. So that's what I'm really watching for. I think that we have to be careful we don't overblow the impact of tariffs. I think there is some of that going on right now. And again, I'll talk about that here in a minute. But it's important to be, I mentioned it's so polarized in Washington. When we look at investments, my job is to be as agnostic as possible in terms of politics, meaning try not to see this with a right colored lens or a left colored lens. Try to think of just pure policy and how's it likely to impact the economy and subsequently the stock market, and how does the market in the past anyway, how has it reacted to short-term news events, and has it had any kind of a lasting impact? So we're going to get into all that in the next segment. We're talking about the state of the economy. We've talked about a very important takeaway from 2024. We talked about Federal Reserve policy. When we come back, I do want to get into the market and the politics and the market, and then we're also going to talk about tariffs and the impact on the economy potentially. And to understand that, we got to look back. What have tariffs looked like in the past? So stay with us. You're listening to More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living here on News Talk 98.7 WOKI. I'm Jim Brogan. We're talking about state of the economy here as we get into the first quarter of 2025, and I know people are on edge. A little uneasy. Not everybody, but a lot of people are, because we see in our offices and we're out when we're teaching in the classes, and I know people are a little bit uneasy. So let's continue to talk about important topics in 2025. Let's talk about tariffs. I know that this is before we talk about tariffs, we got to talk about politics in the markets. So I think right now what we're seeing is we have to be very careful, and this has been true throughout history. We have to be very careful that we don't allow our political lens that we look through and that we view things through to have too big of an impact on our investment policy and our strategy and what we actually do and implement in our financial plan. Typically when we have a Republican White House, Republicans tend to be more optimistic, obviously, and Democrats tend to be more pessimistic. As a result, the party in power tends to be more successful investing because over time markets go up. And that's true with the Democrat Party too. And so we just got to be very, very careful in how we allow our political viewpoints to affect our investment strategy. The market, bottom line, the market is not political. The market does not care about draining swamps. It doesn't care about political retribution. It doesn't care about woke or anti-woke campaigns, and it doesn't care about DEI initiatives. The market cares about policies that do two things: increase or decrease earnings and support growth or hinder growth. And that's ultimately what the market wants to look at. So any political movement or agenda that is viewed by the market as getting in the way of better earnings and growth will be viewed as negative and as a headwind on risk assets, risk investments, regardless of whether these policies are from Republicans or Democrats. And economic policies, political movements and agendas that are viewed by the market as being positive for growth and earnings are correspondingly going to be a tailwind for risk assets, regardless of whether the policies are from Republicans or Democrats. So this is the way we must view political coverage over the next year particularly, but really over the next 3, 4, 5 years. And this will help us cut through the noise and stay focused on the policies that truly impact markets. So when I was talking about not letting our political lens at the end of the first segment affect our investment strategy, this is what I'm talking about. The market is focused on earnings and growth of those earnings for companies. In whatever market you're invested, I was going to say U.S. markets, but really for whatever market you're invested in. Now let's dive into tariffs. What are tariffs? Tariffs, as we know, are taxes on goods imported from other countries, and they're typically paid by companies that import the goods from abroad. So that leads to either tighter margins for companies that are importing, they don't make as much, or they have to increase the price for the consumer because that tax comes in, so then U.S. companies are paying that tax. They got to, and ultimately, affects the costs, right? And that's why tariffs are typically viewed as being potentially inflationary, but in a minute we're going to cut to the chase on this. Now, what are the positives of tariffs? They are seen as a way of growing the U.S. economy over time because they protect domestic jobs and they potentially increase tax revenue. Now, the negatives are the potential for higher costs for consumers and a bump in inflation. Now, it also can be a negotiation tool. And I think that's an important distinction with the current president administration. While companies pay tariffs, they can indeed hurt foreign companies by making their products more expensive and harder to sell abroad. And so otherwise, foreign companies could cut prices to offset the tariffs to maintain their market share in the U.S. But again, that means tighter margins, less gross profit margin. So it's no secret that the prospect of new trade barriers has introduced another layer of volatility in the markets, with markets reacting negatively to uncertainty. And so that's why we've seen the market kind of jumping around a good bit. The Fed is unlikely to respond if it views, I think, an inflationary bump as a one-time bump. I don't think the Fed would be likely to react to that unless they thought inflation was going to not just be a one-time bump and continue to go up. Now, I'm looking at the history of our tariff rates going back to 1930. The average tariff rates in the U.S., so duties collected on the value of goods imported for consumption in the United States, the highest it's ever been was an average of 20%. The average tariff rate on U.S. goods imported. And that was in the 1930s. And of course, we had the Great Depression. So we were trying to protect domestic jobs. Now, tariffs started rapidly coming down. They kind of hit a new low around World War II. Then they started going up again in the 60s. And in the latter part of the 70s, tariff rates went down. And they've been, since 1979, tariff rates have been, on average, less than 4% for all of those years. Since, again, 1994, 95. So we got 30 years here that tariff rates have been under 4%. And for the bulk of those years, up until about 6, 7 years ago, the average tariff rate was less than 2%. It did start to go back up in 2018 and 2019 and 2020 because Trump had implemented new tariffs. And it's come down a little bit since then, but the average tariff rates are around 2%. Now, then the concern, of course, is where does it go from here? But I think it's important to look at history because the reality is tariff rates in the past, if you go back to 1930, have generally been higher than they are now. And again, they were lower through the 90s and early 20s. But tariffs are a normal thing. And, the negotiation tool, I think, is very, very important to understand as well. Now, we don't know where this is going to end up. If we have a full-blown trade war for the next 2 years, that would, in my view, not be good for the U.S. economy and for investing. But I don't think that's likely to happen. Some tariffs are natural. And as I said, could be a short-term pain for a long-term gain. May be more impactful. We might see more economic downturn. We may see, in 2018 through 2020, tariffs went up to around where they are now, and it did not negatively affect the economy. It did not negatively affect inflation. So I'm taking a wait-and-see approach with tariffs and the impact on the economy. What are we actually going to see? And when we look at the data, tariff rates have often been higher than they are now. Now let's talk about things that look attractive in the economy and in the markets. We'll talk about things that don't look good, and we'll also talk about things that have the potential to be kind of ugly. So, the good is the U.S. consumer continues to be very resilient. We believe that the aggregate consumer continues to be in a strong financial position. And that's fact-based. That's based on research. The influx of capital and pent-up demand in the U.S. consumer has allowed the economy to be much more resilient than most have expected, especially in the face of above-average inflation. And contrary to a lot of reports coming out, consumer balance sheets are pretty well fortified. Okay, now do they look as good as they did 2 years ago? No, but they still look pretty good historically. We've also had resilient earnings of the top 500 U.S. companies, the S&P 500. So there is some evidence of slowing growth, but despite that, corporate earnings have remained pretty robust. And I think it's likely to continue in 2025 because growth won't become a structural headwind on earnings, and corporations still have ample room to increase productivity and decrease costs, so increase margins. The market, coming into the year, has been expecting annual earnings growth of about 15% in 2025. That maybe is starting to adjust downward just slightly. But those are good things. Now, what about some not so good things? The labor market is starting to see some cracks. The balance of risk investments has shifted more towards failing on the employment side of the dual mandate in terms of the Fed than the inflation side. And that means, the Fed is starting to be concerned about economic growth. There has never been a recession that did not witness a material increase in the unemployment rate. So I mentioned that dual mandate of full employment. It was down at 3.4, 3.5%, which is pretty much considered full employment. It's now back up just a little over 4. So we started to see a few cracks form over the last few quarters. And if the employment and wage growth slows, the growth rate of the economy is likely to slow. Also, inflation has been a little bit persistent. It's still around 3%. The Fed wants it at 2%. The last mile isn't necessarily the hardest mile in the battle to get inflation down to 2%, but it can take longer to accomplish. So the magnitude of policy actions used to counter deflation may in the end be inflationary. Higher than expected inflation tends to be a major headwind to consumer sentiment. And markets, how the Fed chooses to address inflation is maybe as important as the inflation itself. And then finally, we got a couple of things we're concerned about. One is the Fed making a mistake. The Federal Reserve having a policy error. There's certainly no certainties in markets except for certainty that there's uncertainty. But one thing is near certainty is that higher interest rates will eventually end economic expansion, even as the Fed becomes more accommodative. So, we don't want rates. We want rates to continue to come down some. So the key to a soft landing is the Fed's ability to cut rates before the economy begins to lose notable momentum. So can rates come down fast enough to stoke enough demand in the economy to offset a decelerating economy? So that's what the Fed's got to balance, staying ahead of the curve of economic growth without spurring inflation. And, As I said, when it comes to the economy, it's about growth. And having a hard landing in an economic slowdown is one of the potential ugly things. We believe investors don't need to see a significant increase in recession risk. People are starting to talk much more about the R word. Genuine growth concerns can be enough, though, to cause a pullback in the stock market. And we've seen that in the last 4 weeks. The bottom line is we focus on growth, as slowing growth is likely to halt any kind of a rally. And so, we're in the third year of a bull market. The market was, we had a bear market in 2022. It went down over 20%. We had a great 23, great 24. So we're in the third year of a bear market. And historically, third years tend to be, even in a lasting bull market, tend to be more choppy. So we just want to, understand there's positives, there's things that I'd be kind of neutral on, and there are potential negatives. The key is how you handle your financial plan, which we're going to dive into. We're going to talk about, when we come back, asset allocation takeaways, and we're going to get into planning for 2025 and beyond. How do we address these risks and even capitalize on them? So stay with us. This is More Living with Jim Brogan, right here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
This is More Living, right here on News Talk 98.7 WOKI, where it's all about living the best years of your life your way. And we're talking about the state of the economy and the markets in 2025. We've looked back at 2024. We're talking about important topics of 2025. In a minute, we're going to talk about what do you do about all this? How do you handle your investments? How do you handle your financial planning? How do you do all that? But the one thing I want to mention is, in the first segment, I told you that we are in a stock market correction. And by definition, that means that the stock market is down more than, or has gone down more than 10%. And that's where we are right now. We're right around 10% decline. That's how, since World War II, there have been 48 market corrections on the S&P 500 since World War II. All right, so 48. That's a lot. That's not every year, obviously, but that is most years. Now, how many of those 48 market corrections ended up turning into a bear market? 12 of the 48, so 25% ended up turning into a bear market. And by definition, that means the stock market ended up losing more than, going down at some point over 20%. All right? So 75% of the time, it does not turn into a bear market. And 6 and 12 months later, the market is almost always higher. We've never seen 3 bear markets in a 5-year period. We have seen 2. We had a bear market in 2022, another one this year. If we were to hit that, would be 2 in a 3 to 4 year period. But I think it's just important to understand where we've been historically, because as if we hit 15, 16% market decline, people start to really get nervous. Oh my goodness, we're going into recession. We could see a bear market. Well, what do we do with all of this information? I've mentioned there's some good things out there. There's some things that are just kind of neutral, and there's some potential bad things. Ultimately, the markets focus on earnings and growth in those earnings. It's not political. So what are some takeaways? So one would be, let's talk about asset allocation. How do you need to be handling your investment? And let's talk about the importance of asset allocation. In other words, if you look at asset allocation, that's how much do you have in large cap U.S. stocks? How much do you have in small cap U.S. stocks? Is it in growth-oriented companies? Is it in value-oriented companies, blue chip companies? Is it both? What's your mix of foreign stocks? What regions of the world are you in? Do you have emerging market exposure? How much do you have in bond funds? How much do you have in alternative asset classes like real estate, energy, natural resources, commodities? That's asset allocation. And the reality is, what do investors focus on? Investors overwhelmingly, over 50% of what investors focus on is asset allocation, headlines. The headlines are the main thing that investors focus on. The second most important thing investors focus on are what actual funds they use. Do I buy fund ABC or fund XYZ? And the thing that investors don't really focus a lot on is asset allocation. Now, historically, if we look at the research, what drives portfolio returns? And it's overwhelmingly, almost 90% of portfolio returns are driven by asset allocation and investor behavior. Okay? Headlines and market movements have very little bearing over time on what drives portfolio returns. And the funds that you pick don't have a huge impact. Again, close to 90% of it's determined by asset allocation. Now, the other 10% is important. Not overreacting to headlines and the funds you pick are still very important. It's 10 to 15% of the equation, but it doesn't drive your returns. So, when building a portfolio to meet specific objectives within your constraints, it's critical to select a combination of assets that maximizes the likelihood of meeting your objective. And that asset mix will ultimately dictate returns and variability of returns on your portfolio. So, there was a landmark study in 1986 between Brinson, Hood, and Bebauer found that asset allocation decisions account for 91.1% of a portfolio's long-term return. Focus less on tilts and let your stocks act like stocks. That's a good word. And if I look at things historically, the problem with trying to time the market and fight the market is you not only have to get out at the right time, but then you have to get right back in at the right time. And that's a double whammy. You got to be right twice. So I'm looking at the growth in the stock market since 1871. And it's a pretty steady line up. It's about a 45-degree angle consistently over time. So I'm looking from 1871 through 2024. So obviously, that's a long period of time shrunk into a chart. And so it's going to smooth out some of that choppiness, obviously. But we see a big downturn here in the Great Depression. We see a little bit of a downturn, certainly in the early 90s, and then of course we had the Great Recession, and we had the Great Recession of 07, 08, 09. But at every point on this chart, when I go back and look at the stock market has continued to go up, there have been many reasons investors could have made a case that the S&P 500 is overvalued and stocks are expensive, and that the future was dim. 2 world wars could cause a market collapse. Think about that. The young generation was lazy. All generations have kind of felt that way, right? Politicians are going to mess something up. There's always been concerns, but over time they've always been wrong. The problem is time. You've got to have time on your side, which is one of the biggest things I want to impress upon you today. Staying invested for long-term gains is where you have to be. We have to be invested when markets have their best days. But that means we're also going to be invested when markets have their worst days. So if I go back and look at the last 80-some years, back to 1927, the stock market has returned. If you stayed invested, reinvested gains, all that stuff, you're looking at a 9.7% return per year over all those days, all those years. If you miss the 10 best days in the market, instead of 9.7, you'd be up 8.5% per year. And if you miss the 20 best days, your return instead of 9.7 is 7.5% per year. And unfortunately, that's what emotion does to us with the market and with volatility. And many of the best days in the stock market have been, right after some of the worst days. And it pays to stay invested. The stock market has a history of resilience. It consistently recovers from short-term crises to achieve long-term growth. Timing the market is very, very dangerous. You have to be right twice. You have to predict the best moment to buy and sell, and it often leads to missing out on some of these significant gains. You also need to expand your time horizon. If I'm investing for what my money's worth a year from now, the stock market is just a gamble. But if I'm investing for where things might be 10 to 15 years from now, I have a lot more confidence in the market paying off. And viewing things through that lens helps eliminate the behavior gap. A short time frame and viewpoint can lead to emotional decisions and excessive trading. And this typically results in poor outcomes. So instead, we want to be focusing on longer term growth. So it's now, how do you do that in a financial plan? How do you focus if markets, the key on the market investing is to focus on the long term. How do you do that when you're about to retire, you're retired, and you need income? So that's what we're going to get into in our last segment. Stay with us. We'll talk about financial planning ideas for 2025 and beyond. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living here on News Talk 98.7 WOKI. I hope you're enjoying your weekend as we're celebrating Tennessee basketball, baseball, softball, swimming. The list goes on and on. So congratulations to the men's team. Good luck to the women today, this afternoon, as they play in the Sweet 16. I'm talking about the state of the economy and the markets in 2025 as we move forward here. And I mentioned the importance of staying focused on long-term goals. Let's talk about consumer sentiment, because it's very important to understand what the history tells us with consumer sentiment over time. And so, one of the main indexes that people track for consumer sentiment is a University of Michigan Consumer Sentiment Index. And if we go back to 1952 and look at consumer sentiment since 1952, and what has happened in the stock market in the 12 months following when consumer sentiment is really, really high, people are confident, feeling good. And then what does performance look like when consumer sentiment is very low? And when we've been our highest, the highest 5% of all markets with consumer sentiment since 1952, the average return of the S&P 500 the next year, 12 months, was 3.9%. Poor performance. Now, if I look at when consumer sentiment was at its lowest, in the lowest 5% over the last 72 years, the S&P 500 the following 12 months was up 18.7% over the next 12 months. So consumer sentiment has plummeted the last 2 months, and it's now among the lowest levels it's been in the last 70 years. We're in the bottom 5% of consumer sentiment. But the good news is, historically, that's been a good indicator. It's like a contrarian indicator. When consumers feel less confident, usually the market is better in the next 12 months. So that's where we've got to keep that long-term focus. Now, how do we keep a long-term focus when markets are so unpredictable and volatile and choppy in the short term? And the first is in your asset allocation and balancing risk and reward. So, none of us want to lose money, but we want to make money. And the reality is, if we need to stay invested so that we're invested on the good days, that means we're also going to be invested on the bad days. And so we have to balance risk and reward. I have found that how much we want to try to make on our money is somewhat a function of how much we're willing to lose. So we're going to have bear markets. I feel very confident in that. I also feel very confident we're going to have bull markets. We always have. And the question is, what are you comfortable with losing when the markets are bad? And if you want to reduce that risk, so when we have a bad market, you don't lose as much, does it make sense that means when we have a bull market, you're probably not going to make as much? So see, it's a balance. And your asset allocation is what can drive the level of risk. When we say risk investment, the reality is There's different levels of risk. There's aggressive, there's conservative, and everything in between. Risk is risk. That means there's no guarantee principle. But there's anything from conservative risk to aggressive risk. So understanding your asset allocation, the more things that you own that don't move up and down with the stock market. In other words, the more things you own that if one thing zigs, another zags, you're going to have less choppiness. That means that when markets are substantially down, you're hopefully going to have a few things that are doing pretty well or holding their own, and you don't lose as much. But that means when markets are booming, you're going to own a few things that aren't doing as well, and you're not going to make as much. So it's all about balancing that risk and reward. And then the other is time horizon. We talk often on this show about you've got your safe money holdings and you've got your risk money holdings. And your risk money holdings are what give you the best opportunity to fight inflation over time. The problem is it's completely unpredictable in the short term. Well, how do you invest for the long term when you're retired or getting ready to retire? And the answer is you've got to create time horizon in your investment plan and financial plan. Well, how do you do that? You structure, I'm a big fan of splitting out your money based on when you're going to need it. The money that you're going to have that's going to have the hardest time beating inflation is short-term investments that have certainty and security. Treasury bonds, CDs, high-yield savings accounts. They guarantee principal, and right now you can still be getting over 4%, which is better than the inflation rate, but that's an anomaly. Over time, those more stable options it's hard to keep up with inflation. What they do provide is stability in the short term. So see, this is what we should be living on in our financial plan in the short term. We've got to give our risk investments time to go through the inevitable ups and downs of the market, because we're going to have them. And the less time you have, if you create a portfolio that, you've got enough money in your safe money bucket that you can go for 6 to 7 years, if necessary, without touching your risk investments, so you don't have to sell them when they're down and spend that money. That means you can't be aggressive as somebody that's 45 years old and isn't going to need to touch their investments for 15 years, right? So it's all about balancing risk and reward and understanding how can I create time in my financial plan. The best hedge historically to mitigate the impact of down markets is having time on your side, as long as you're diversified. Now, that diversified could mean diversified within the stock market, number one, but then as you get older and you don't have as much time, we've got to invest in other asset classes that can provide some balance and diversification. And then finally, planning for tax rates in the future. The Tax Cuts and Jobs Act is set to go expire at the end of this year, which means income taxes are going to go up. Most think that will not end up happening because Congress will act, because we have a unified Republican side of government, albeit it's a small one, a small majority. But it's, likely they're going to extend the Tax Cuts and Jobs Act. But, the problem with tax planning is looking forward. It's not tax preparation. Tax preparation is looking through a rearview mirror. Tax planning is looking through the front, through the windshield. We want to focus on what we can do in the future. And tax rates, we're shooting at a moving target. We don't know where tax rates will be in 10 or 15 or 20 years. But I do know we have an out-of-control deficit spending. And we have huge amounts of debt, right? $36 trillion in debt. So I'm confident in one comment. I cannot guarantee you this, but I'm confident that the tax environment we're in today for federal income taxes specifically, I don't think we'll ever see a lower tax environment the rest of our lives. Certainly if you're over 50, more than likely even you young folks. So how can you take advantage of that? Look through the front windshield, be intentional about your investment plan, how it impacts your taxes, how you draw income, how that affects your taxes. How can you be intentional, understanding that taxes have to get paid, and how do you manage that appropriately? So today we've talked about your wealth, because greater wealth provides for more living, so you can live the best years of your life your way. Many thanks to Wayne for engineering the show. Thanks to Jill for helping produce the show. Have a great, great weekend. You've been listening to More Living with Jim Brogan, only on News Talk 98.7 WOKI.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.